Good day everyone, my name is Marcus,
And I'm Jimmy.
and if you're new to the channel, welcome. If you're not, thank you so much for supporting us all this while. Just remember that every like and subscription goes a long way in supporting our channel's production. Now before we dive into today's video, have a look at these disclaimers before we proceed.
So, what exactly is intrinsic value? So, according to Investopedia, intrinsic value is a measure of what an asset is worth. This measure is arrived at by the means of an objective calculation or complex financial model rather than using the currently trading market price of that asset. Now, don't get me wrong. Everyone has their own unique toolkit for determining intrinsic value, but why learn from me when you can learn from one of the greatest value investors of all time? Most of the lessons in this video were derived from what Buffett publicly said in all of his investor conferences.
So some of the important criteria that can be used here is the future cash flow, both in terms of inflow and outflow to the owners or to the business over the next few decades, or maybe even when the business is done and dusted. You then discount the cash flows from the modern appropriate interest rate, which you can get from long-term government bonds. That will give you the end result of the appropriate price range for the intrinsic value of a company. Warren Buffett also mentions that you need to understand the fundamental workings behind a stock or a business to get the most accurate calculator of your intrinsic value. He also mentions that you need to understand the fundamental workings behind a stock or a business to get the most accurate calculation of your intrinsic value. If it is a technology company, you need to understand what are the catalysts that could drive up the value of the company. Be it whether they have patent rights to a certain technology that has not been discovered by any of their competitors, or maybe even a new product that has not even reached the market yet and they're keeping it in hiding just because they want to make sure that they have sufficient stock before they enter the market. That's for a technological company. And another example is if you look at a drug company, a catalyst could come in the form of knowing when the exact approval dates are for the drugs they are developing and how they can spike the net worth of the company. For example, take a look at one of the most popular pharmaceutical companies this year, Regeneron Pharmaceuticals, ticker symbol REGN. They had such a huge spike in their share price, almost 51% year to date, all because they had developed certain market pioneering drugs that are in wide demand in the pharmaceutical sector. But because these catalysts are huge, you have to understand that they are a double-edged sword as well. Just because they can drive the share price up if the drug trials are successful, it also means that the share price of the company could come skyrocketing down once the trials have unveiled unsuccessful results.
You also need to have a solid understanding of the competitive forces surrounding the company and whether they stand a chance to sustain their business model into the future, or will they be disrupted easily by external forces. Do they have a foolproof business model, or is it one that was just built around just copying others? The third point he mentioned was that in calculating intrinsic value, you should aim to get a ballpark figure, not a solid number, because that's humanly impossible to calculate unless you are a supercomputer. The best place to get this figure is from the annual report of a company. It's like the Bible for intrinsic value. Reminiscent of the 1918 Spanish flu, since the staggered reopening of the US economy, it was reported that 22 states have seen uprising trend of COVID-19 infections, and that a second wave has likely already begun as of 10th of June 2020. At the time of writing, the US has surpassed 2 million in total infections. We believe that the reopening is to reduce financial stress on the Federal Reserves, lessen the impact of economic damage, as well as to save the re-election on the bid of Donald Trump's campaign in November 2020. This goes against the word of his top health official, Dr. Antonio Fauci, who has warned that the reopening of economy too early will lead to a second wave of infections. Coupled with the global protests over the recent Black Lives Matter movement, we expect community transmissions to continue ravaging through the masses. In the 1918 Spanish flu pandemic, certain US cities faced higher death rates during the second wave of infections compared to that of the first wave. Retail-driven rally. The recent rally has resulted in a strong disconnect between valuations and reality. Companies filing for bankruptcy protection, such as Hertz, had their share price rally by more than 600% from its June 3rd low, while prominent companies with stressed fundamentals, such as Royal Caribbean, had their share price increasing more than 300% from its March low, despite having a heavily impacted bottom line for the second quarter of 2020. It was reported that Robinhood and other major online brokers saw floods of new clients, up to 170%, viewing the coronavirus market beatdown as a generation buying moment, along with zero commission trading. Robinhood had a historic 3 million new accounts opened in the first quarter of 2020 as a result. At the same time, such speculative bets were further fueled by excess liquidity granted by governments, meant to bolster the negative effects on households.
Now, besides the three factors that we listed for intrinsic value, another factor to consider in the current stock environment is the advance of retail traders into the market as the coronavirus pandemic sidelines many professional investors. I quote, "Day trading has replaced sports betting as a form of entertainment," reads a headline from Axios. And this phenomenon could partly explain the current disconnect between the economy and the stock market. Big price actions seen in the stocks of bankrupt companies like Hertz, JCPenney, and Whiting Petroleum have also underlined this aforementioned trend as newbie investors, mostly those on Robinhood, rush to buy everything that moves and are not stopping to take a breather and to understand really what the company is really worth and whether they are really getting a bang for their buck. An example will come in the form of Hertz. I'm sure many of you who are watching this channel have heard of Hertz some way somehow. They have been in the news for the past 2 weeks. So basically the story behind it is how Hertz wants to sell almost $1 billion in stock and is seeking approval from the bankruptcy courts. The stock was up 37% at the time of making this video and is already rallying 410% off the 56-cent low. If you are not aware, Hertz declared bankruptcy, so it's kind of worth zero even though the price is still rallying. Fancy behavioral economists call this whole scenario limits to arbitrage. This will be the first time a company raises money in the stock market while going through a bankruptcy. Everyone might think it's ridiculous, but we think that is quite a genius move actually. Remember, the year is 2020 and nothing actually makes sense if you're still looking at the stock market through a pre-2020 lens. Last month, crude oil traded below zero, which means you are literally getting paid to buy crude oil, and if you sell, you're losing much more money. The whole world flip is lit, so why should Hertz be any different? Now anyway, concluding this video, we must remember that intrinsic value is an important metric for any long-term investor because it allows the individual to get a gauge of the business health of the company. An investor focuses on what the business can do, whereas a speculator or a day trader focuses on what the price can do. Because for a speculator or day trader, it is not important whether the company is a solid business. It is more important if the price action shows a lot of potential for spiking and shows a lot of volatility. So if you want to truly be a long-term investor, you should definitely look at intrinsic value. And understanding the company is what it means to be invested in the company. And you will actually feel as though you own the company, you own the shares, and you have direction over the CEO's actions. So to sum up this video in 4 simple points, if you want to calculate this big black hole known as intrinsic value, you need to look at 1. Future cash flows. Secondly, discount it to the present. 3. Get a rough ballpark figure. As Warren Buffett said, focus on being approximately right rather than being precisely wrong. And the last one is focuses on businesses that you can understand because some businesses are just too hard to put a figure on. The last point is very important because I want to talk about how Warren Buffett and many other billionaire investors such as Bill Ackman invest in Coca-Cola even though it has largely been called a dead company. Reason being, Coca-Cola's business model is very easy to understand. They make a syrup, they market it to other competitors, and their brand is literally plastered over many famous places and objects in the world. And this is why they have so much brand power, and this is why they are here to stay, because people love their brand and people love drinking Coca-Cola. So this is a business that is very simple to understand for these billionaire investors who have a lot of money to put and they don't necessarily want to put it in a risky company such as a technological one where they have no idea where the company is going to go because they do not understand the primary product that a company is selling. But of course, I'm not advocating that you should follow them. You should definitely do your own due diligence and invest in a company that you can pluck out information from the snap of your finger. Again, we hope this video has enhanced your understanding of one of the most important concepts in the stock market. Knowing intrinsic value will allow you to understand what you are really getting in before jumping into a stock. I've attached some links to channels below which I took reference from. I'll also be flattered if you had one key takeaway from this video which you can share with your other friends. Leave any questions you have in the comments and I'll try my best to answer all of them thoroughly. Stay tuned for the next video and invest safe.
Ever since the day that you